Hello, I am G. Rajkumar Nair, retired General Manager PNB. Public sector banks are not bad as projected. For the last few years, public sector banks were at the receiving end due to higher NPA, generating loss, pumping in taxpayers' money for recapitalization, etc. They were shown as a sign of inefficiency in credit dispensation, undue favors to corporates, and whatnot. Mind it, every business has a cycle, a boom period, and a lag period. Banking is no exception. It is the same set of officials with the same set of rules handling credit now also. Now, during 22-23, all PSBs have turned the table. They have started showing increasing profits quarter after quarter. Good news coming in for the last 1 month. PSB's profit jumps 65% in quarter 3. Four PSBs recorded more than 100% growth. A cumulative profit of rupees 70,000 crore made up to December 22. That is 15,000 crore in Q1, 25,000 crore in Q2, and 29,000 crores in Q3. Q3 profits of PSBs are near to that of private sector banks. Going by the trend, a 1 lakh crore profit is expected by the year end, as any realization in fully provided account goes to profit directly by early resolutions given by NCLT or NARCL. Government expects 40,943 crore as dividend from RBI and PSBs in March 23. Budget raised it to rupees 48,000 crore for 24, year 24. Please note that RBI profit is also an indirect contribution by banks through CRR, open market operations of bonds, government bonds, participated by mainly by the banks, and forex profit. Those pointing out recapitalization amounts to public sector banks should also calculate the cumulative dividends paid by these banks over previous years, that is, by PSBs and RBI together. One should also note that private banks do not pay dividends to the government. One can also argue that higher profit is due to non-passing of rate hike to depositors, resulting into higher margins. But it can also be argued that one of the reasons for low profitability for ester years were also due to squeezing of spreads on an unprecedented low interest rate regime. It was the corporates who were getting benefited due to this low interest rate regime. So I thought this is an apt time for making an analysis of the poor performance of public sector banks for the last few years. Before coming into that, I would like to remove certain mistaken views that are getting circulated. That is one, government or finance ministry do not make any decision on loan sanctions or write-offs. Operating guidelines are issued by RBI in a professional manner and not by the government. Decisions on large corporate advances are taken by the board of the bank based on recommendation of several set of officials at branch, regional office, zonal office, and with a recommendatory committee at head office level. Board comprises of whole-time directors of the bank, independent directors, plus one representative each from RBI and Government of India. The officials are from the bank officials are from credit department, risk management department, and treasury. There is a combined effort or contribution by all departments together. These sanctions are based on pre-approved credit policies of the board in line with RBI guidelines, and deviations, if any, are to be clearly brought out. This is the brought out. The same is the position with the private sector banks also. Other than the above board representation, Finance Ministry in reference is limited to fixing profit and dividend budget every year. The second point which I want to convey is that an account becomes NPA generally after 3, 4, or more number of years after granting the loan. Mostly it is due to poor cash flow that is less than what has been projected earlier at the time of granting the loan due to external and internal factors. External factors are due to government or industry policy changes, competition, alternate products, obsoleteness of the products, etc. Internal factors are due to incompetent management, mismanagement like diversion of funds, etc. In short, the increase in NPA in a year or few years are out of those loans disbursed during earlier years due to very many factors. Let us look into that. Indian banking faced with innumerable changes and challenges during the last 30 years. They came in one by one with unexpected implications. By the time a resolution is found out, another one sets in like that. Some of them are one, liberalization and globalization in 91-92 resulted into many corporates opening up subsidiaries and joint ventures in various countries, including safe havens. For sourcing materials for payment for parent organizations or for undertaking their projects assignments abroad. In this process, fund transfer to them became a routine business transaction. Two, ICICI and IDBI, who were processing project loans, were converted into commercial banks in mid 90s. Thereafter, all banks started processing project loans. Three, since 2005, banks were computerized, bringing under core banking, introduced corporate net banking, remote processing of clearing checks, auto classification of trust accounts and NPA, diverting much of the bankers' attention to implement, understand, and implement these new processes. Fourth, to push infrastructure development, lot of infra loans were dispersed, resulting into infra portfolio going up from 1.5% to around 15-16% of the credit portfolio for most of these banks. Some of them got stuck up at finishing stages on technical grounds, resulting into cost and time overrun. Some resulted into overcapacity creation and unhealthy competition. Five, Lehman Brothers failure in 2009 with a worldwide impact in the financial field. Six, abolition of CDR restructuring scheme in 2018 resulted into many accounts becoming NPA who got asset classification protection under the scheme. Similarly, abolition of non-CDR restructuring schemes with direction to refer default cases to insolvency and bankruptcy court also paced up NPA level till resolution. Raghuram Rajan's stricture to declare all NPA within a stipulated time with good intention to clean the balance sheets brought out NPA much more than anticipated. Recapitalization could not be done to the extent immediately, resulting into poor credit growth and higher NPA level. Now, a natural question will come: why private sector banks are not having this much NPA percentage? The answer is PSBs were having a major market share of about 75 percentage or so until few years back of the total credit portfolio. Only major two private banks were actively participating in corporate loans consortiums. Another major private bank was keeping away from corporate loans, concentrating on retail sector. Three, these two private banks were having more or less equal level of NPAs at one particular time, but they could downsell stressed assets quickly to ARCs, thus reducing the percentage of NPA. Four, PSBs for fear of accountability, CBI or vigilance angle delayed taking decisions for sale, adding more woes leading to further deterioration of assets. Five, some private banks who syndicated consortium loans actively were also in the practice of downselling their share quickly so that their profitability from non-fund based fees or income is increased on a year-on-year basis. Thank you. Thank you.